and of course, there's a famous quote from Hemingway, how do you go bankrupt? Slowly at first and then suddenly. And I think, we're going to see that very much in the economy. As I say, more and more people are getting into what I'll call the suffering phase. I think we're set up for a scenario where there could well be violence. If people do not, if half the population simply do not accept the results of the election, that is a setup for violence. And there was I think we mentioned this last time, didn't we, David? Over 40% of registered Democrats said it would be justifiable to use force to stop the Republicans taking control of the presidency this November.
Adrian Day returns to the show. He is the CEO of Adrian Day Asset Management and the portfolio manager of the Euro-Pacific Gold Fund. He'll be answering questions about inflation, economic outlook. He'll be responding to Jamie Dimon's claim that inflation is sticky. He'll be responding to Ray Dalio's claim that there's a more than 30% chance of a civil war in the U.S. And of course, we'll be getting Adrian's outlook on the markets. This episode is sponsored by Novium, a really interesting pen company. It's a really cool pen. Stay tuned for the message. Welcome back, Adrian. Good to see you again.
Well, thank you, David. Thank you for having me.
I want to start by playing you this clip from Jamie Dimon, CEO of JP Morgan, interview he did yesterday. Take a listen.
So what do you think the future is for inflation and interest
rates? I'm a little more worried about it. I mean, we've had very big fiscal deficits, and I think the underlying inflation may not go away the way people expect it to. And I look at the future, like a lot of things we look at are kind of inflationary. The green economy, the remilitarization of the world, the infrastructure requirements, the restructuring of trade, fiscal deficits. So I think there are a lot of inflationary forces in front of us that may keep it a little bit higher than people expect. So the surprise would be rates are higher, inflation a little bit higher, and maybe that'll slow growth. And obviously geopolitics is a whole different issue. That could be determinative in what our economy does next year, and we're just not going to know.
Okay, so a few things he said there, right? Inflation may stay high for all those forces that he listed, and the result of that is higher rates for longer. Do you agree?
Yeah, I generally agree. I mean, I certainly think inflation is going to be a lot more stubborn than a lot of people are imagining. And, there's obviously deflationary forces, but there's also inflationary forces. So, it's a question of weighing the inflationary forces against the deflationary. But yeah, I suspect we're going to have a much more stubborn inflation than most people are thinking. Higher for longer is a more problematic thing because it comes into, I mean, certainly we've been higher for longer. There's no question about that so far, because you only have to go back to last December and look at the dot plot and look at Jerome Powell's comments at the press conference after the Fed meeting in December and look at what the Fed funds futures rates did back in December. So we've already been a lot higher and longer than people expected. But from where we are now, the problem is there's economic questions, but there's also fiscal questions. And, the big question for me, as for many people, is the federal government deficit. You simply can't keep rates too high for too long without it completely blowing out the deficit already, the interest on the federal debt already, which is going up every single day this year. But already the interest rate on the debt is more than Medicaid, it's more than defense, it's more than Medicare. You can't have a budget where 100% of your budget goes towards just servicing your debt. So I think at some point they're going to have to ease that.
Jamie Dimon referenced the fact that the economy may slow down, where at least the growth will be slower as a result of the higher deficit that you talked about and higher rates for longer. But will it actually, Adrian, think about it, rates have been higher for longer in the past, right? We've had steady 5%, 6% Fed funds rate in the past. And, there was economic growth then. Why can't we have 5% or 4% even and still have growth?
Right. Are you talking about the last couple of years, or are you talking about previous periods in history?
Just previous periods in history, yes.
Yeah. I think the huge difference today is the debt. When you've got large amounts of debt at the federal government level, the corporate level, and corporate balance sheets are strong, don't get me wrong, but if you look at corporate debt, just debt, there's a lot of debt out there, and then household debt, of course. So all of the debt in the economy is so much more, but so much higher than it was in previous periods, say the 70s, when we had high interest rates. And so as we keep interest rates high for longer, then more and more people, more and more households, more and more corporations and the governments start to run into difficulty. I mean, just to put it in sort of human terms, a person that bought a secondhand car 8 years ago when interest rates were lower, zero lower bound here, and maybe paid, I don't know what you pay for a used car, but maybe he paid 4%. And his car is just about ready for the junk heap right now. The fact that rates have gone from 0 to 5% is not affecting him at the moment. But when that car stops running and he has to buy a new car, and he's not paying 4% for his car, he's paying 8% for, or 10% for his car, then that household is significantly affected. And every week that goes by, or every month that goes by with rates higher for longer, more and more people are seriously affected by the higher rates.
And Adrian, there are signs that the economy has been slowing down in terms of growth. Last quarter's GDP came in lower than expected. The leading economic indicators, as you know, has been in contraction territory for quite some time, and yet no recession, no official slowdown. What's keeping things afloat?
Yeah, what's keeping things afloat, in my view, is the fact that we had 12 years, basically, since 2008, since the great financial crisis, and then even more so since the COVID in 2020, we've had excessive injections of liquidity into the system. We've had interest rates, go down to zero lower bound, as I mentioned, before rising again, but we've also had these huge injections of money. And so that enabled households and corporations over the years, it enabled them to refinance their debt at lower rates. Everybody refinanced their mortgages, for example. It enabled corporations to term out their debt. So corporations, you see them every day, every corporation I follow. Some company is refinanced or was refinancing its debt. And so we entered this period of rates going up with certainly corporations and many households in a far better state than they would have been. But as I've mentioned to you before, if you look at the average length of time from the start of a rate hiking cycle until the onset of a recession, the average length of time is about 28 months. One of those is an anomaly of 50 months. So even if you take that out, you're still talking an average of 22 months. And we're only now at, basically 2 years. So, but the average is 28 months. So we're not even at the average length of time from the onset of rate hikes to the onset of a recession. We're not even there yet. And with the easy money that we've had for so long, it would be logical to expect that to take longer.
Wall Street, though, has a slightly more optimistic view. This is from the Wall Street Journal that came in a couple days ago, earlier this week. Investors crowd into soft landing trade ahead of crucial inflation data. This was before this week's CPI release came out. 3 straight months of hot inflation data dented Wall Street's confidence that a series of interest rate cuts is set to start any minute. Investors are hoping the 4th time is the charm. A mood of renewed optimism about a soft landing for the U.S. economy has swept across trading desks in the days ahead of Wednesday's release of the CPI. Actually, Wednesday's release of the CPI, as you know, prompted a market rally, not a sell-off. So there's renewed optimism, and the sense of optimism hasn't diminished so far. So what are people optimistic about exactly?
Well, I think there's optimism, but there's also an awful lot of cash in the pockets of the 1% and the 10% and the 20%. And those people are optimistic. When I get money pouring into my gold fund, what do we buy? We buy gold stocks. And so that makes me optimistic.
Okay.
Sorry, but what I mean
I understand what you mean. Yes, yeah.
The wealthy people have money and they're going to put that money to work. So what are they optimistic about? I don't know. I think they're missing things. I think if you look, as I say, the average length of a recession, from the rate hiking cycle, we haven't even got to the average yet. But if the headlines of some of these things, GDP, employment, are quite strong. But if you look under the hood, I don't think they're strong at all. And I think what Wall Street might be missing is, and this is old news, but they might be really missing the fact that there are two economies in the US right now. The top 20%, the top 50% even, are doing reasonably well. And everyone in Wall Street is talking to people in that top 20%, and they're all doing well. But the bottom 50% is doing very, very badly. So when you average it out, the aggregates don't look too bad, but half the population is really suffering. I mean, just look at employment, for example. You see a little tick up in unemployment. What was it, 0.1% or something? Okay, but look at the labor participation rate, which inched up, but is still at basically a 40-year low. You look at the number of part-time jobs. If you look at the number of full-time, private sector jobs, you see we're already at very high levels of unemployment. People are working two jobs because they have to. And so I don't think the employment picture is as strong as the unemployment rate itself would lead us to believe. And we could say the same about retail sales and everything else.
Before we move on to the next topic, I want to spend a minute to talk about our sponsor today, Novium, which has a really unique and interesting product, a pen. Now, I know what you're thinking. It's not unique. I've seen pens before. Why are you talking about a pen? Well, let me tell you, first of all, this is possibly the coolest pen I've personally seen. But even before I talk about the product itself, let me try to sell you on the idea of a pen. Why do we need it? Why can't we just type everything out on the computer like most people? Well, here's a study. According to a study done in Norway, actually many academic studies have done this, writing things down by hand helps you to retain information better than typing it out on a computer or a smartphone. So if you're thinking about writing things down for note-taking purposes, using a pen is still the old-fashioned way to go. However, writing can get tedious and can cause soreness in your wrists and fingers. That's why having the right pen for the job makes a big difference. Introducing Novium's luxury hover pens. The hover pen defies gravity and levitates on a stand with the use of magnets, making it an elegant statement for any office or home setting. This pen is crafted from aircraft-grade aluminum, which gives it a polished finish, and it's available in 4 different colors. The hover pen is refillable and offers a more comfortable and pleasant writing experience than most other pens due to its ergonomic design. Novium's hover pen was also one of Time Magazine's 2022 Inventions of the Year, and it has recently wrote out its hover pen Future Edition, a fountain pen like no other I've seen, or you as well, probably. So act now. You can get 10% off your hover pen using the code DavidLynn at checkout. It's the perfect gift for Mother's Day, Father's Day, or really just any day. Free international shipping is also available to most destinations, so use the link in the description down below or scan the QR code here. Just check it out, look at it, take a look for yourself. I think the pen speaks for itself. Speaking of employment, April's non-farm payrolls was quite weak. April added 175,000 jobs compared to 315,000 in March. Some investors saw that as kind of good news for the markets because the rationale here is that a weaker labor market would eventually slow down inflation, eventually prompt the Fed to cut rates. Do you follow that logic?
Right. Yeah, well, Powell himself that's been the traditional way of looking at it. And Powell himself said it just, in his last press conference. He said in answer to a question, would they start cutting rates more if unemployment got worse? And his answer was yes, but not by 0.1% or 0.2%. I mean, meaningfully worse. So yes, if unemployment starts to pick up, and I know you talked about new jobs, not unemployment, but if unemployment starts to pick up meaningfully, if the jobs picture, let's say, if the jobs picture deteriorates significantly, I think that's obviously a big factor that will influence the Fed.
Okay. What is your outlook then on what the Fed will do this year?
Well, I haven't talked to Jerome Powell recently.
I thought you had him on speed dial, Adrian. You're disappointed. I'm kidding.
He hasn't confided in me. You know, I think there really is. I mean, everybody talks about the dilemma that the Fed's facing, but I think Jerome Powell himself feels this dilemma very, very acutely. He very much wants to keep rates high to fight inflation. But I think he also realizes that the higher rates, the longer rates stay high, it's going to have an impact on the fiscal deficit. It's going to have an impact on unemployment. It's going to have an impact on the economy. And so I would suspect that we're going to be higher than most people think for longer. But at some point, and of course, the election sort of gets in the way of the schedule. And whatever Powell says, they know when the election is. And it has to be, even if it's not in the minutes, it has to be something that's in the back of their minds when they're discussing this. But I think by the end of this year, we're going to start seeing rate cuts.
Even if inflation stays sticky, Adrian?
I think so, because the economy is just slowly getting worse, in my view. And I mentioned unemployment, it ticked up 0.1%. But, you know, these things, if it ticks up 0.1% every month, that becomes meaningful after a while.
Someone made this analogy. I don't know if you agree with this analogy. It's a frog. It's like a frog in water boiling slowly. It doesn't feel the temperature going up 1 degree at a time, but eventually the frog dies. It doesn't know why.
Well, exactly. And of course, there's a famous quote from Hemingway: how do you go bankrupt? Slowly at first and then suddenly. And I think, you know, we're going to see that very much in the economy. As I say, you know, more and more people are getting into what I'll call the suffering phase. Rates on credit card debt are now, I think the average is now 24%, 24.5%. And for poorer credits and some credit cards, it's even higher than that. So people who've been who haven't been paying off their credit cards every single month, and that's not Jamie Dimon. I'm sure he pays off his credit card every month. People who haven't paid off their credit cards every month, they are suffering, because when you're paying 30%, 29% interest rate on your credit card, it's very, very difficult to get ahead.
By the way, I know somebody working at a bank. I'm not going to name which one, but he told me that credit card rates are likely to go up, not down, because the interchange rate has gone down. So they need to make that up with higher rates going forward, even if the Fed cuts rates. So,
well, sure. And when Congress interferes and says, well, you can't charge people a late penalty fee, and you can't do this, and you can't do airline awards and all that kind of stuff, as a new bill in Congress says, that only means that they have to just raise their flat interest rate.
I'm going to throw something that's somewhat of a wild card at you. This is from Ray Dalio. He made a speech recently. Article came in from Fortune magazine yesterday. Just read the first 2 paragraphs. Billionaire investor Ray Dalio believes the chances of a second American Civil War stand better than 1 out of 3, and is urging investors to move part of their assets out of the country. He believes that this year's presidential election between incumbent Joe Biden and challenger Donald Trump is the most important one of his lifetime, and will serve as a litmus test that determines whether risks spiral out of control. So he said, now we are on the brink. These are his words. He told the Financial Times in an interview published Thursday, estimating the probability of strife erupting at somewhere between 35 to 40%. It doesn't explain how he arrived at those numbers, but anyway, it's high. What are your thoughts?
You know, if I had said that, you'd probably call me crazy and conspiratorial. You'd cut it out of the interview. No, you know, let me see. The first thing, I think it's difficult to think of a scenario if Biden and Trump are both the nominees of their party in November, which it seems like they will be. But, you know, Biden might step down and be replaced, and anything could happen to Trump. But if those two are the nominees, it is difficult to think of a scenario where the opposing side will be satisfied that the election was fair if the other side wins. In other words, Republicans will think there was cheating if if Biden wins, and Democrats will think, you know, it's all because of the electoral college, and you know, it's so on and so forth. So I think we're set up for a scenario where there could well be violence if people do not, if half the population simply do not accept the results of the election. That is a setup for violence. And there was I think we mentioned this last time, didn't we, David? There was a very significant survey done by the University of Virginia's Political Center. I forget the name now. Oh, I'm sorry, but it's a very respectable political institute at the University of Virginia. And they did a survey, non-political, non-partisan rather, and they did a survey of registered voters. Over 40% of registered Democrats said it would be justifiable to use force to stop the Republicans taking control of the presidency this November. 40%. Now, most of those people aren't going to do anything about it, but that's still a reflection of the sentiment among the populace, I think. And if the economy is clearly getting worse at that point, that only is going to make the threat of violence worse.
What do you think then of Dalio's investment implication for what he said? Basically, he's suggesting that investors move capital out of the country. Now, he's not saying all of the U.S. is uninvestable. He lists some sectors that he thinks has some growth potential, but he also said that countries that earn more than they spend and have great balance sheets, have internal order, and are neutral in the geopolitical conflict look attractive. He cited India, Singapore, Indonesia, Malaysia, Vietnam, and some Gulf states as possible destinations. What's your reaction?
Yeah, well, of course, a lot of those countries, ordinary retail investors in the US can't invest in. But I agree. I mean, if we have, I mean, and he's putting it as a less than 50% chance of violence, right? But still high risk. So if you have a meaningful risk of violence in the US, given the fact that the economy is slowing down, given the fact that we have an awful fiscal deficit, I think it only makes sense to start being defensive and to protect yourself. And part of that means moving some money offshore. Part of that means moving out of the stock market. Part of that means moving into gold. So yes, I would agree. I would agree with that general scenario. I mean, I'm not sure I'd, you know, go to India as a way of protecting my assets, but general theme, I certainly agree with.
Well, I know you like gold, and we'll talk about gold next. So leading into gold, let's talk about the dollar. So China came in recently. China sold a record amount of Treasury and U.S. agency bonds in the first quarter, highlighting the Asian nations move to diversify away from American assets as trade tensions persist. So Beijing offloaded a total of $53.3 billion of Treasuries and agency bonds combined in the first quarter, according to calculations based on the latest data from the U.S. Department of Treasury. Why do you think they're doing this?
Well, we know why they're doing it. I mean, they're doing it for two reasons. One is to diversify their assets, as you just said, or to diversify their assets, because they were simply, from an investment point of view, they have too much of their reserves, central bank reserves, the country's reserves. They have too much in one single asset, the US dollar. So it just is prudent to diversify that, particularly if you're worried about the US dollar and the US, you're worried about the US's fiscal deficit, which over the longer term will affect the dollar.
That's the key now, Adrian. I mean, they've been invested in treasuries for a long time. And why now? Why diversify or start selling off now on record? I'm not saying this is the first time they've sold treasuries, but this is the first time they sold this much in this little time.
One is the fiscal deficit is really coming to the fore at this point. But the second thing, of course, is the weaponization of the dollar. When the US, and this has been talked about a lot by people more eloquent than I, but when the US uses its hegemony in the world, uses the SWIFT system to penalize and to sanction people it doesn't agree with, and that might be Russia, where they just took Russia's reserves as well as just taking, you know, the assets like yachts and houses of Russian so-called oligarchs, people start to get a little bit nervous. And so it's just prudence for people to say, well, let's move some other assets to a place that the US can't touch. So you know, I think that's just prudence. And in my view, that's just going to continue. You know, if you look at the bond purchases, you mentioned what China's been selling. Last month, interestingly enough, China and Russia, obviously erstwhile two of the three top foreign buyers, didn't buy any, but Japan was still a big buyer. But now, you know, we're seeing Japan's interest rates move up. If the yield control ends in Japan and the Japanese yen starts to move up, it's all incremental. But if rates start to move up and the yen starts to move up, a lot of the institutional money from Japan is going to move, which supported the US bond market over the last 12 years, is going to start moving back to Japan. And so if Japan, Russia, and China are not buying their bonds, you know, there's basically no large foreign buyers. There's buying out of Cayman, but that's all hedge funds, of course. There's buying out of Belgium, and that's all, you know, European funds. It's not Belgium itself buying. Yeah, then I think that means that the dollar is going to decline. And where do these people put their money? I mean, you know, 5 years, 10 years ago, they might have put some of it into the euro, but I don't think a lot of central banks are wanting to have too much in the euro right now. You know, gold is clearly the answer. Physical assets and gold are the answer. By physical assets, I don't mean commodities. It could be commodities, it could be factories, but, you know, real assets.
Well, China has been adding to its gold reserves. If you look at any chart of China's gold reserves, it's just been going up in a straight line, especially in the last 2 years. Here's one explanation as to why they've done it. This is from Jita Gopinath. She is the managing director of the IMF. She said in a speech, this suggests that gold purchases by some central banks may have been driven by concerns about sanctions risk. This is what you were talking about. Is that the concern they have? They're buying gold because they want to limit the risk of getting sanctioned by the US?
Well, absolutely. If you think that's a risk, you want to get your money out of the US as soon as you can. And that's clearly what's been happening. And look at the countries that have been doing it. It's not Germany or Britain that have been, you know, moving out of the dollar and buying gold, but it's the Gulf nations, it's the Asian countries, it's the emerging.
Why hold gold though? Why not just hold cash in their domestic currency?
Well, I think typically in a central bank's reserves, you want to be diversified, and gold has been a staple of central bank reserves for centuries. And the countries that we're talking about, China and in the Asian countries, many of the emerging market countries, they, despite the buying in the last 2 years, they still remain significantly underweight gold in their reserves relative to the Western countries. So I think there's a lot more to go.
Last time you and I spoke was in January of this year, and at the time gold was still trailing around $2,000 an ounce. Huge move since then. I don't have to tell you. This is something that's been interesting to me, though. Gold has been correlated positively with the dollar, interest rates, and stock market. So risk assets and the dollar and gold. This is not, you know, a trifecta of correlations we see very often. Does that concern you that gold's momentum is perhaps short-lived because those other indicators usually are contra-indicators? Yeah.
Yeah, no, you're absolutely right. But no, that is exactly a reflection of what has been happening. But we've just talked about the buying for gold over the last year and even this year, but over the last 18 months, including this year, the buying has come from central banks wanting to diversify their assets in the face of the weaponization of the dollar. They're not looking at what the dollar is or what interest rates are or what the US stock market is. They're doing it as a long-term defensive move. You look at Asian, the second largest segment of gold has been Chinese savers. Chinese people are worried about the banking system. They're worried about the slowing of the economy and the potential for stimulus, all of which will hurt and the potential for devaluation of the yuan. So they're looking for a place to put their assets. They don't want to put them in the banks because the banks are unstable. They don't want to put them in real estate in China for pretty obvious reasons. We don't want to talk about that. And until recently, they haven't wanted to put them in the stock market. They're not allowed to put them in crypto. So the only place left to protect your assets is gold. So Chinese buying of gold has been remarkably strong in the last 6 weeks. I'm talking about private buying in addition to the government. And now those people too, they're not looking at, well, what's US interest rates doing? What's the S&P doing? They're buying for other reasons. And so I think yes, you're absolutely right. And the factors the factors that you mentioned, the macroeconomic environment, which is very negative for gold, if you just look at it, not looking ahead, just looking at where we are right now, is negative for gold. And that's why Western investors, both North America and Europe, are simply not buying gold at the moment. You look at the GDX is continuing to get outflows. I just looked at, even now, I looked at the last weeks, 3 days they've had inflows, 3 days they've had outflows.
Outflow from North America, you mean? Not from Asia.
The GLD, I'm sorry, the GLD.
Yeah, the GLD, the Asian investors have been going in. Outflows from North American investors, you mean?
Yes, exactly. So the macroeconomic environment, which is negative for gold, has meant that Western investors, retail investors, institutional investors, generally speaking, there's always buyers and sellers, but generally speaking, they are not buying gold. They have not been buying gold. You're absolutely right. And the GLD, which is the physical gold ETF, has seen net outflows. As I say, I looked at the last weeks. 3 out of 6 days were outflows. But if you look at this year, we've had maybe 4 out of 5 days have been outflows. You look at coins, which is a good reflection of retail. All the coin dealers I talk to say they're getting more people calling them to sell their gold than they're calling them to buy gold. That's true in Europe as well as in North America. And a reflection of that is the premiums on coins and the deliveries, the shipments from the mints. They're way down. So that's a reflection of a lack of interest. So you're absolutely right. But from a contrarian point of view, I think that's, I feel very, very positive about that because it means people are just not overweight gold at the moment.
Is there any risk of the Chinese government banning the sale or owning of gold like they did with Bitcoin? I'm just thinking perhaps the people band together and start trading amongst themselves in gold. That's not something that the government wants.
Well, I think the biggest risk, is definitely some change in regulation or some change. It could just be a change in sentiment. I mean, the problem when you're looking, there's 2 big buyers here, and so there's 2 answers. One is the central banks and one of the Chinese savers. The Chinese savers are smaller in size than central banks. And the problem with the central banks is a pretty obvious one. If you've got basically 5 or 6 central banks that have been steady buyers for the last 18 months, well, maybe you only need 5 or 6 people to change their mind for even only for a couple of months. And that has a meaningful, I'm exaggerating a little bit, but if the Chinese central bank and the Russian central bank and the Uzbekistan central bank and the Thai central bank all decide at the same time that they're going to hold off on buying more gold for a little while, that's a meaningful amount of the global demand for gold. And the same could happen with the Chinese buyers. I think a bigger risk, to be honest with you, David, a bigger risk is that if they devalue the yuan, which a lot of people are talking about, then Chinese people who bought gold will have a big one-time gain in their gold holdings. and they might, on the incrementally, they might decide to sell their gold and buy Chinese stocks, which would then be even more valuable.
Okay,
So
well,
yes, it's a risk.
we know that the Chinese investors don't like North American gold miners because that inflow hasn't gone in there. Their GDX is still trading at a near 50% discount from its highs in 2011. And when you look at it, Adrian, the gold miners are still at a discount from its highs by a large margin, while gold has surpassed its highs by a large margin. This disconnect has worried a lot of gold mining investors because there's two ways to look at it. I was telling you offline. A, either gold miners are a value trap and you should stay away, or B, they're the best buy ever.
No, absolutely. If we're right about gold, let's say 12 months from now and 18 months from now, if we are right about that 12 months from now, so we're going to see interest rate cuts and gold is going to stay more or less where it is, then I would say that the gold stocks are the most incredible buy imaginable. And for two reasons. One is, you're looking at companies, and just as an example, Agnico, which has obviously had a huge run in the last 6 weeks. It's been one of the top performers, but it is still selling. It's at the high price now since the middle of, for 3 years. It's at this high price for 3 years. But on a price to free cash flow, it is still selling at essentially the lowest multiple that it has in 40 years. If you look at Barrick, same thing, essentially the lowest price to book value and the lowest price to cash flow in 20 and 30 years. So the stocks are remarkably undervalued. And you look at the first quarter earnings, but from most companies were pretty good. Let's not forget the big move in gold didn't happen until March. So right now, gold mining companies are selling their gold for $200 more than the average price they sold in the first quarter. So we're going to get a very, very strong second quarter in terms of cash flow. The gold stocks are cheap. They're doing well right now this year. They're doing very well. The cash flows are very, very strong. And we have a remarkable, because of the peculiar circumstances that we've talked about with gold buying and so on, we have a remarkable opportunity where gold has taken off, but the gold stocks are still remarkably, are lagging and are still remarkably undervalued. If you look at gold this year, the gold stocks have only just in the last week outperformed gold. If we'd have had this interview a week ago, I would be saying that gold is still outperforming the gold stocks of this year. But if you look back to 1976, look back to 2001, look back to 2009, at the beginning of big gold moves, you didn't have the opportunity to buy the gold stocks. Let me just say, go back to 2001. In first 6 months, the XAU was up 27%. Gold was up less than 5%. So anyone who wanted to buy gold stocks had to chase them. You look at 2008, even more dramatic. The XAU was up 50% in 1 week from the bottom, and it was up 70% in 1 month from the bottom. And gold was up about 20%, in 3 months. So again, if you wanted to buy gold stocks, you had to chase them. Right now, we're in a situation where gold, as you know, is up, 20% this year. And we don't have to chase the stocks. They're still lagging. They're still remarkably undervalued. It's an anomaly, but an anomaly we should take advantage of, I think.
Here's my counter argument, and let me know if you agree or disagree. Gold has outperformed the S&P 500 year to date. So it's about 17%. The S&P is up about nearly 12%, right? Depending on the day. As of today, it's about 12%. Anyway, gold's up, which seems to me that investors were preferring the physical over the stocks. And until that sentiment changes, we're not going to get capital shifting into the miners. Agree or disagree?
Oh, I agree with about 100%. And so the question is it a total value trap? And are we going to go back to where we were 2 years ago? or what is going to make investors want to buy gold? What's going to make investors buy gold are the things you talked about earlier that are not happening yet. One is a decline in the dollar. One is a more stimulus, which will probably mean lower interest rates. And the third thing is, you know, the S&P beginning to roll over. Doesn't have to crash, just has to roll over. But you're right. So long as the dollar remains strong, interest rates remain high, and the S&P remains on fire, people are not buying gold stocks.
Have the producers, that some of the ones you've listed, have they been good at managing costs this year? How are their free cash flows?
Oh, tremendous. You know, Agnico always is, they give, I think it's conservative guidance, they call it realistic guidance, but they knocked it out of the park in the first quarter. And again, remember, so the Pan American had strong cash flow. I mean, all of Fortuna had remarkably strong, you know, large and intermediate. They've all got very, very strong cash flow. But remember, this quarter to date, or where the gold price is today, is $200 above where the average price that they sold in the first quarter. So if gold stays anywhere close to where it is right now, the second quarter earnings are just going to be even that much stronger than the first quarter.
And by the way, you said earlier that you expect over the next 12 months for gold to stay where it is. You're not expecting a big increase or decline either way.
No, I didn't mean that at all. Sorry, I misspoke.
Okay.
What I meant was is, if we look ahead and gold is anywhere near where it is today, in other words, it hasn't crashed and burned,
right?
Then I think we're going to see the gold stocks start to get real bids.
What is your reasonable estimate, educated guess as to what it will do?
Gold?
Gold,
well,
yeah.
You know, we don't like answering those questions. You don't give time and price, and it's largely or partly a reflection of what the dollar does. But you know, by the end of a year, I wouldn't be at all surprised if we saw, well, I wouldn't be at all surprised at this point if we see 2,500 and 2,550. And a lot of people listening are going to say, is that it? Is that all there is? But let me just say one other thing. Sorry, but people that are buying the gold stocks right now are big, the US gold stocks, because it's not Chinese buyers, as you said. The people that are buying the North American gold stocks right now are, by and large, very large, sophisticated buyers. They're people like Druckenmiller. They're people like Michael Burry. They're people, you know, sophisticated, big buyers. Retail buyers are not yet buying. Now, those people can be wrong, of course, and the retail can be right, but that's not normally the way it goes.
So let me reframe the question. So gold there's three things it can do: crash and burn, stay where it is, or go up. Okay. So, you know, we know that staying where it is or going up is good for the mining stock. So let's just evaluate the probability of it going down, crashing and burning. So what are the variables that need to be in place for that to happen? Surging US dollar, completely, you know, low inflation or elimination of inflation, retail taking profits, abandoning gold altogether for whatever reason, right? Evaluate the probability of those factors that I just listed. Yeah.
And I would say not only inflation going down, but also rates staying up for various reasons. So rates staying up and a diminishing probability, or perception rather, a diminishing perception that in fact rates are going to come down dramatically, and they're not going to come down before inflation is conquered. The risk, the odds of that, I would put, you know, very, very low, frankly. I think that's the way I assess it, the biggest risk, if you like, is that things continue as they are, with inflation where it is, a little bit higher, a little bit lower, but rates continue where they are, and therefore the dollar remains strong for the next 6 or 9 months. That would hurt, and there's no violence in the election. That would cause gold to go down because, you know, people would sort of give up. You know, but people like Druckenmiller and Burry and the others we could mention, they're not buying gold stocks because they're looking for a 10 or 20% move in the next 3 months. I think they're buying gold stocks for a longer term fundamental move.
Yes, that makes sense. Finally, how do you feel about the juniors? We haven't talked about the junior sector. Equally optimistic or no?
Well, yes and no. I mean, first of all, from an investment point of view, I think when the gold stocks, as they like to say, as Rick Rule frequently says, don't buy hamburger when the filet's on sale. And the big cap stocks are still, in my view, very undervalued. So the place to put most of your money right now, in my view, is the big cap miners and the big cap royalty companies. You look at a company like Franco, yeah, you wouldn't confuse it with a value stock. Ben Graham would probably cough and splutter before he bought it. But in terms of its own historic valuations, is trading at well under its average historic valuations. So anyway, those are the stocks that will move first. When people start moving into the gold stocks, I mean, Druckenmiller, for example, didn't buy Ajax Exploration. He bought Barrick and so on. So the first stocks to move are always the larger stocks, and also they're the more certain to move, which means if gold goes to 25,000 or 2,500 or 3,000, you can be pretty sure that Barrick and Newmont and Agnico and Wheaton and Franco, you can be pretty sure that all of those will give you good returns. You can't say the same for Ajax Exploration and Consolidated Moose Pasture. So I would always start with the big ones. But there's incredible value among the juniors, both the junior producers, you know, the single assets who might get taken over, as well as, frankly, the exploration companies, some of which haven't moved at all. And some of those are incredible buys. But what I would say, just closing on this one, what I would say is you need to be so much more selective about those. And I would focus on companies that either have strong balance sheets, meaning they have enough cash for a runway of at least 18 months or 24 months, or they have revenue such as Origin or Mondaro, which actually have cash flow coming in, or at least they have access to capital, right? It's a kind of company you know can always raise money if they need to. But I would be very cautious of companies with low balance sheets and not enough money.
Final question. What is this kind of company that can always raise money if they need to?
Well, I mean,
you don't have to lift names. I'm just saying, what have they done differently? That
okay, companies that in the past have always been able to raise money and have put that money to good use. So you know that if Robert Friedman comes to market looking for $100 million, he can raise it. In a really bad market, he may not be able to get quite the same price as in a good market, but he can always raise it. You don't have to worry about the deal falling apart.
Okay, so good track record. Thank you very much. Well, speaking of good track record, where can we follow you and your track record and your work?
Well, the website is adrianday.com.
Okay.
And that has information on both the money management and the newsletter.
Very good. Thanks very much, Adrian. Appreciate your time.
Well, thank you, David. I always enjoy it.
Thank you. We'll speak next time. Thank you for watching. Don't forget to like and subscribe.